In the world of trading, understanding volatility is not just an advantage, it is a necessity. Markets do not move in straight lines. Prices expand and contract in cycles driven by liquidity, sentiment, and institutional behavior. Those who fail to recognize this rhythm often chase entries too late or exit too soon. Bollinger Bands remain one of the most respected tools among professional traders for a simple reason: they work. Not because they predict the future, but because they reflect what the market is actually doing in real time. When properly understood, they help you identify high probability trade locations, manage risk with greater precision, and avoid costly emotional decisions. This guide focuses on 4 time-tested strategies using Bollinger Bands that align with how serious traders approach the markets. Each method offers a different lens through which to interpret volatility, whether you are looking to fade extremes, ride trends, capture breakouts, or simply filter noise from price action. Trading is not about having more indicators, it is about knowing how to use the right tools at the right time with discipline. Bollinger Bands are one of those tools. Let us begin. First, strategy trading at the upper or lower Bollinger Band. Understanding the principle in depth. In the financial markets, prices rarely move in straight lines. Rather, they tend to oscillate within zones of equilibrium where supply and demand temporarily balance each other. Within these zones, certain technical tools help traders visualize areas where price may have temporarily stretched too far in one direction. Among these tools, Bollinger Bands are often considered one of the most reliable for this purpose. At their core, Bollinger Bands are constructed from 3 components. The middle band represents a simple moving average, usually over a period of 20 bars. The upper and lower bands are calculated at a set number of standard deviations, typically 2 above and below this moving average. This mathematical construction ensures the bands dynamically adapt to volatility expansions and contractions in the market. The upper band is not merely a line on the chart, it reflects a zone where price is statistically extended relative to recent behavior. In many cases, it represents a zone where bullish momentum may be overextended and susceptible to mean reversion. Similarly, the lower band often signals that bearish pressure may have pushed prices too far down, creating conditions favorable for a potential bounce. Professional traders do not treat these bands as magic levels of support or resistance. Rather, they understand these areas as shylight zones where crowd psychology may be reaching an emotional extreme. Fading these extremes when supported by other evidence can offer high probability opportunities. How to apply the strategy with discipline. The first and most important condition for applying this strategy is recognizing the type of market environment in play. This method is fundamentally designed for markets that are range-bound or lacking strong. Directional conviction in such environments, price tends to revert to its mean, oscillating between the upper and lower bands like a pendulum swinging between extremes. When price approaches the upper Bollinger Band within a sideways market structure, it often signals that bullish enthusiasm is speaking. Traders can look for signs of exhaustion, such as small body candlesticks, long upper wicks, or bearish reversal patterns, to consider short positions. Conversely, when price approaches the lower Bollinger Band under the same conditions, it often signals that to bearish sentiment is becoming overextended, evidence of rejection from these lower levels through bullish reversal patterns, increased buying volume, or divergence in momentum indicators provides a basis to consider long positions. Refining the execution process. Simply observing price touch the upper or lower band is insufficient for execution. A professional approach demands confirmation from multiple factors to build a higher probability trade thesis. These may include, but are not limited to, observing the structure of the candlesticks. Round the bands, do they show hesitation, indecision, rejection? Analyzing volume characteristics, is there a spike in volume, indicating potential exhaustion of the prevailing move? Reviewing momentum oscillators such as the relative strength index, is there divergences suggesting weakening strength in the current direction? Assessing the broader market context, are there higher timeframe levels of interest aligning with the Bollinger Band extremes? A disciplined trader waits for the market to reveal clear signs of imbalance rather than acting prematu. Rely on the first touch of a band. This patience distinguishes professional behavior from emotional impulsiveness. Risk management considerations. Trading reversals near Bollinger Bands in range-bound markets can offer attractive reward to risk ratios, but it is not without challenges. Price can and often tend to temporarily overshoot these bands during periods of volatility spikes. Without a clear exit strategy, traders risk holding positions against a move that may become a trend. Stop-loss placements should not be arbitrary. Common practices include depositioning stops just beyond recent swing high or lows relative to the entry triggered by the rejection at the band. Alternatively, volatility-based stops using measures like the average true range can provide a dynamic adaptability to changing market conditions. Position sizing should reflect the higher likelihood of being stopped out during periods of market noise. No single trade should carry disproportionate weight within the broader trading portfolio. Capital preservation remains paramount. Psychological discipline required. One of the most overlooked aspects of this strategy is the psychological discipline required to execute effectively. Range-bound trading of 10 feels counterintuitive to newer traders. Buying weakness and selling strength runs contrary to the emotional impulses driven by fear and greed. Yet this story shows that these zones frequently offer the best risk-adjusted opportunities. Traders must cultivate patience to wait for setups to fully form, discipline to act without hesitation when conditions align, and humility to accept when the market invalidates the thief. And move on without attachment. Emotional resilience is particularly critical during drawdown periods. Bollinger Band extremes may trigger entries that fail due to temporary volatility spikes. Recognizing the CS part of the statistical nature of the strategy, rather than personal failure, is key to maintaining long-term consistency. Case study example. Consider a stock consolidating within a clearly defined range over several weeks. The upper Bollinger Band consistently aligns with prior swing highs, while the lower band mirrors prior SWA. Glow's volume dries up near these extremes only to surge upon rejection. A patient trader observes price approaching the upper band with small candlestick bodies and wicks rejecting higher prices simultaneously. Their relative strength index shows bearish divergences, signaling waning momentum. The trader enters a short position with a stop loss above the recent highs and a target near the lower band or the midline. Over the following sessions, price drifts lower, fulfilling the mean reversion expectation. This textbook example illustrates how patience, confirmation, and risk management combine to make this strategy effective. Common mistakes to avoid. One of the most frequent errors among less experienced traders is attempting to apply this method during strong trending conditions. Bollinger Bands wide and during trends, reflecting volatility expansion. In such environments, price can ride the band for extended periods, a phenomenon of 10 referred to as walking the band. Attempting to fade these moves prematurely leads to frustration and losses. Another mistake is entering solely on the touch of the band, without additional evidence. This reduces the strategy to mere guesswork rather than a probabilistic edge based on confluence. Over-leveraging positions under the false assumption that bands will always hold leads to catastrophic drawdowns. Markets owe not rate or a bounce or reversal simply because a line is touched. Finally, abandoning the strategy after a few failed trades ignores the statistical nature of mean reversion. Trading is a game of probabilities, not certainties. Success comes from consistency over a large sample size, not isolated outcomes. Integrating into a broader trading plan. Bollinger Band's extreme strategy should not exist in isolation within a trading plan. It complements other approaches, such as trend-following breakout strategies or momentum plays, depending on the prevailing market conditions. A well-rounded trader adapts tools to context, not the other way around. Combining this strategy with higher timeframe analysis increases its potency, identifying daily or weekly support and resistance levels that align within trade A. Bollinger Band extremes adds weight to these. Two-Pand improves expectancy. Backtesting and forward testing this method across multiple instruments and timeframes refines its application and builds straighter confidence in its statistical validity. Final thoughts. Trading reversals at Bollinger Band extremes requires more than recognizing patterns on a chart. It demands understanding the underlying principles of market structure, volatility, and crowd psychology. It requires meticulous execution of entries, stops, and targets grounded in probabilistic thinking, not hope, when used with DISC. Applying patience and proper risk management, this strategy can serve as a reliable component of a professional trading arsenal. It offers a structured approach to capitalizing on the natural oscillations of price within range-bound environments, providing both clarity and confidence to those who master its nuances. As with all strategies, success lies not in the tool itself, but in how skillfully it is wielded by the trader behind the screen. Second strategy, Bollinger Bands squeeze anticipating volatility breakouts. Understanding the principle of volatility compression. One of the most reliable characteristics of financial markets is that periods of low volatility tend to be followed by periods of high volatility and vice versa. This cyclical behavior reflects the ebb and flow of liquidity positioning and crowd psychology. Markets consolidate when participants are indecisive or accumulating positions, then expand when conviction returns. The Bollinger Bands squeeze strategy is built upon this foundational truth. When the bands contract significantly, it signals that volatility has diminished and the market is coiling in preparation for a more substantial move. The tighter this, the greater the potential energy building beneath the surface. Technically, the squeeze occurs when the distance between the upper and lower Bollinger Bands narrows to levels significantly below their historical norms. This contraction reflects reduced standard deviation of price movement, meaning the market has centered a phase of Q. UIE consolidation beneath which pressures are mounting. Professional traders view these periods not as times of inactivity, but as opportunities to prepare for breakout trades. Once price breaks decisively from the squeeze range of volatility, expansion of talos creating favorable conditions for directional trades. How to identify a genuine squeeze. Note all narrow bands indicate meaningful opportunities. Therefore, it is crucial to distinguish between ordinary contractions and true squeeze setups. Avalid squeeze of 10 exhibits the follow. Wing characteristics. Price volatility reaches multi-week or multi-month lows relative to the instrument's history. The bands contract visibly on the chart of 10 appearing flat or parallel, indicating equilibrium. Price becomes strapped within a tight horizontal range, reflecting indecision and balanced supply-demand. Volume typically diminishes during this phase, reinforcing the lack of conviction among participants. Seasoned traders use statistical tools, such as Bollinger Band width indicators, to quantify the degree of compression area ding near. Historical lows provides additional confirmation that as squeeze is occurring, higher time frame context also matters. As squeeze forming near key technical levels, such as prior highs, lows, or pivot zones, carries greater weight as it suggests potential for a significant breakout beyond mere intraday noise. Executing the breakout trade with precision. The core objective of the squeeze strategy is to position oneself for the breakout, not to predict its direction in advance. While some traders attempt to forecast the move based on patterns or sentiment, the professional approach focuses on reactive execution. Traders prepare by identifying the boundaries of the squeeze range. Marking recent swing highs and lows within the compressed band structure provides clear reference points for breakout levels. Entry orders can be placed just beyond the C extremes to capture momentum as it develops. A buy stop order just above the upper range boundary and a sell stop order just below the lower boundary ensures participation regardless of breakout direction. This neutral positioning removes emotional bias from the head decision-making process, allowing the market to dictate the trade. Once triggered, stops should be placed within the range on the opposite side of the breakout to minimize a risk if the move fails. This tight stop placement reflects the understanding that valid breakouts should not return deep into the squeeze zone. Managing trades post-breakout. Successful management of squeeze breakouts requires recognizing that initial volatility expansion of 10 leads to rapid price movement, but not always sustained trends. Therefore, profit targets and trade management should reflect realistic expectations based on the instrument's typical behavior. Some traders employ fixed reward to risk ratios, exiting at predefined multiples of their initial risk. Others use volatility-based targets, measuring the average true range to project likely price travel following the breakout. Trailing stops offer an adaptive method to capture extended moves while protecting gains as volatility increases. Stops can be trailed beneath swing lows in an uptrend or above swing highs in a downtrend, adjusting as the market struck. URI evolves. It is essential to monitor momentum and volume during the breakout phase. Healthy breakouts typically exhibit rising volume and strong directional candles. Weak follow-through or immediate reversals warrant caution and may justify tightening stops or exiting early. Psychological discipline required during squeezes. The patience required to execute this strategy cannot be overstated. Squeezes set up soft 10 develop slowly with price action appearing stagnant for extended periods. This lull can tempt traders into premature entries or abandoning the sup out of boredom. Emotional discipline demands waiting for confirmation through actual price movement beyond the range boundaries. Anticipating breakouts without evidence leads to whipsaw trades and unnecessary losses. Professionals understand that missed opportunities are preferable to poorly executed ones. Furthermore, traders must resist the urge to widen stops, so add to losing positions if the breakout falters. Such behaviors violate the principle that valid breakouts should follow through promptly. A failed breakout is avalid exit, no tan invitation to hope for recovery. Common mistakes to avoid. One of the most frequent errors in applying the squeeze strategy is assuming every contraction will lead to a significant move. Markets can remain compressed longer than expected, and not all breakouts lead to sustained trends. Traders often misjudge context attempting squeeze trades during times when broader market conditions do not support volatility expansion. For example, applying this method during major holidays or ahead of critical news events can lead to falsity, now's due to artificially suppressed liquidity. Another mistake is chasing breakouts late after the initial move has already occurred. This exposes the trader to higher risk as stops must be placed further away, reducing the reward to risk profile. Chasing price also often coincides with the exhaustion phase of the breakout. Finally, failing to account for the direction of the prevailing higher timeframe trend can lead to counter-trend trades with lower probability. While the squeeze itself is neutral, context matters, aligning breakout trades with the dominant and trend increases the odds of success. Integrating Bollinger Squeeze with broader strategies. The Bollinger Bands squeeze is not a standalone trading system, but a powerful component within a diversified approach. IT excels when combined with other technical frameworks such as market structure analysis. Identifying squeezes setups at key support resistance levels adds confluence volume profile analysis. Confirming breakout levels align with high volume nodes or areas of prior imbalance. Momentum indicators, using tools like moving average chi, convergence divergence to confirm expansion phase higher timeframe alignment. Trading squeezes in the direction of weekly or monthly trends filters low probability setups. Backtesting this strategy across various market conditions, instruments, and timeframes refines its application and builds trader confidence. Observing how past squeeze resolved aids in developing realistic expectations for future trades. Case study example. Consider a major currency pair consolidating within a narrow 50 pip range over several weeks, Bollinger Band. Contract visibly on the daily chart, reflecting the tight consolidation. Price repeatedly tests both range extremes without breaking through. Volume remains subdued during this period. A professional trader identifies the squeeze marks the range boundaries and sets conditional orders just beyond the levels. One morning, price breaks above the upper boundary on strong volume, accompanied by bullish momentum indicators. The trader is triggered into a long position with a stop placed below the lower range boundary. Over the following sessions, the pair are allies sharply expanding volatility as anticipated. The trader trails the stop beneath higher lows, locking in profits as the move progresses. Ultimately, the trade captures as a significant portion of the breakout move, demonstrating the effectiveness of the strategy when applied with discipline. Final thoughts. The Bollinger Band squeezes strategy embodies the principle that preparation precedes opportunity. By recognizing the signs of volatility compression, traders position themselves to exploit the inevitable expansion that follows. This approach is not about prediction, but about readiness. Success lies in waiting patiently for the market to reveal it, and then acting decisively with a clear plan for entries, exits, and risk management. It requires a mindset grounded in probabilities, not certainties, an understanding of market behavior, not mere patterns on a chart. When integrated thoughtfully into a broader trading methodology, the squeeze strategy provides a reliable mechanism for capturing some of the most powerful moves in the market. Those who master it gain an edge-rooted noting compo. CT boot in the timeless nature of volatility cycles. About one third strategy, combining Bollinger Bands with moving averages. Third strategy, combining Bollinger Bands with moving averages for trend following and precision entries. Understanding the synergy between Bollinger Bands and moving averages. Markets rarely operate in isolation. Price action reflects the ongoing battle between buyers and sellers, with trends and consolidations forming as a result of shifting supply and demand dynamics. To navigate these movements with precision, professional traders often combine tools that complement each other, rather than rely on any single indicator in isolation. Among the most effective combinations is the use of Bollinger Bands alongside moving averages, particularly exponential moving averages. Bollinger Bands provide a real-time picture of volatility and potential overextension. They excel at identifying periods when price is stretched relative to its recent mean. However, by themselves, Bollinger Bands do not define the underlying trend. This is where moving averages, especially exponential moving averages, add significant value. An exponential moving average places greater weight on more recent price data, allowing it to respond more quickly to changes in trend direction than a simple moving average. By combining Bollinger Bands with a carefully selected exponential moving average, traders gain a clearer framework for distinguishing between trending and ranging markets. This clarity enhances both entry precision and trade management. The most common practice is to align the Bollinger Band's middle line with the same period as the exponential moving average, typically 20 periods. This creates a unified view where the center line not only reflects the mean of recent price action, but also offers guidance on trend direction and momentum strength. Identifying the correct market context for this strategy. This combined strategy excels in trending environments where price exhibits orderly pullbacks toward the mean before continuing in the direction of the prevailing trend. In such markets, Bollinger Bands help visualize the natural ebb and flow of price oscillation, while the exponential moving average confirms whether the pullback is a temporary correction or the beginning of a reversal. An uptrend is typically confirmed when price remains above the rising exponential moving average and uses the middle Bollinger Band as dynamic support. Conversely, a downtrend is reinforced when price stays below the falling exponential moving average and treats the middle band as resistance. In these scenarios, traders seek to enter in alignment with the trend during pullbacks that touch the middle band, positioning themselves for the next impulsive leg. Recognizing the broader market structure is essential. This strategy is most effective when employed within clearly trending conditions confirmed by higher timeframe analysis. Attempting to apply it within choppy or sideways markets often leads to frustration and suboptimal results. Execution steps for precision entries. The process of executing this strategy involves several methodical steps designed to enhance probability and manage risk effectively. First, identify the prevailing trend direction using the slope of the exponential moving average. A rising average confirms an uptrend, while a falling average confirms a downtrend. Neutral or flat averages suggest standing aside until clearer conditions emerge. Second, observe how price interacts with the Bollinger Bands and the exponential moving average. In an uptrend, look for pullbacks where price retraces to the middle band without breaching the lower band. These moments often coincide with reduced momentum and provide ideal opportunities to enter in the direction of the dominant trend. Third, seek confirmation through price action patterns at the zone of confluence between the exponential moving average and the middle band. Bullish engulfing candles, pin bars, or bullish outside bars at this level strengthen the validity of a long entry. In a downtrend, the inverse applies with bearish formations confirming short opportunities. Fourth, execute entries with clear risk management parameters. Stop losses should be placed beyond the opposing Bollinger Band or recent swing points, providing a logical structure for the trade based on market behavior rather than arbitrary levels. Fifth, define profit targets using a combination of Bollinger Band extremities and projected price moves consistent with the average true range. In strong trends, trailing stops beneath higher lows in an uptrend or above lower highs in a downtrend allow for capitalizing on extended moves while protecting gains. Advantages of combining Bollinger Bands with moving averages. This strategy offers several key advantages for traders seeking consistency and reduced ambiguity in decision-making. First, it provides a clear visual framework for understanding where price is within the context of its trend and volatility cycle. The middle Bollinger Band serves as a dynamic mean reversion point, while the exponential moving average confirms the broader directional bias. Second, it filters out counter-trend signals that often lead to losses in trending markets. By requiring alignment with the exponential moving average, traders avoid the common pitfall of attempting to fade strong trends prematurely. Third, it enhances timing precision. Rather than entering impulsively or based on vague sentiment, traders wait for price to interact with known areas of value supported by objective technical criteria. Fourth, it supports scalability across timeframes and asset classes. Whether applied to equities, currencies, commodities, or indices, the principles remain consistent, providing a versatile toolset for diverse trading styles. Psychological and behavioral considerations. The success of this strategy hinges not only on technical execution, but also on the trader's psychological discipline. Pullback entries within trends often require patience and confidence, particularly when waiting for price to retrace against the prevailing direction. Fear of missing out or reacting to minor fluctuations can lead to premature entries or exits. Moreover, respecting the integrity of the exponential moving average as a trend filter demands humility. Markets occasionally fake out traders with brief breaches of the middle band before resuming trend direction. Accepting small losses as part of the process rather than abandoning the strategy preserves long-term profitability. Emotional resilience is also tested when managing trades through volatility. The temptation to take profits too early or widen stops in the hope of recouping losses undermines the statistical edge provided by this disciplined approach. Case study illustration. Consider a leading technology stock exhibiting a strong uptrend on the daily chart. The 20-period exponential moving average slopes upward consistently. Price experiences periodic pullbacks to the middle Bollinger Band, but respects the level without closing below it for more than 1 or 2 sessions. During one such pullback, a bullish engulfing candlestick forms precisely at the middle band, coinciding with increased volume. The trader enters a long position with a stop placed beneath the recent swing low and the lower band. Over the following weeks, price resumes its upward trajectory, touching the upper band multiple times before showing signs of exhaustion. The trader either exits at predefined targets aligned with previous highs or uses a trailing stop beneath the rising lows to capture further gains. This disciplined adherence to the strategy yields a high reward to risk outcome with minimal drawdown. Common mistakes to avoid. Despite its strengths, this strategy is not immune to misuse. Common mistakes include entering trades when the exponential moving average is flat or directionless, signaling a lack of clear trend. This often results in whipsaw losses as price oscillates without commitment. Another error is over-reliance on the Bollinger Bands alone, without regard for broader market structure or momentum conditions. Bands expand and contract with volatility, but do not predict direction. Ignoring higher timeframe trends increases the likelihood of counterproductive trades. Failing to wait for confirmation through price action at the middle band exposes traders to unnecessary risk. Premature entries based on anticipation rather than evidence erode the statistical edge of the method. Finally, abandoning the strategy after a few unsuccessful attempts demonstrates a misunderstanding of probability. No method yields 100% success. Consistency over a large sample size distinguishes profitable traders from amateurs. Integrating into a broader trading plan. The integration of Bollinger Bands and exponential moving averages fits seamlessly within a comprehensive trading framework. It complements strategies focused on breakout entries, mean reversion, and momentum continuation. By providing structure and clarity, it reduces emotional decision-making and enhances consistency. Regular review of performance metrics such as win rate, reward to risk ratio, and expectancy refines application over time. Journaling trades with detailed notes on context, execution, and outcome supports ongoing improvement and professional development. Combining this method with fundamental analysis, market sentiment, and macroeconomic considerations further strengthens trade selection and timing. Alignment across multiple factors increases confidence and conviction in each decision. Final thoughts. Combining Bollinger Bands with exponential moving averages represents a fusion of volatility awareness and trend alignment. It transforms these tools from passive indicators into active components of a disciplined trading approach. Success requires patience, clarity, and adherence to process, but the rewards are well worth the commitment. Traders who master this strategy gain not only technical proficiency, but also the psychological fortitude to navigate markets with confidence. They understand that trading is not about predicting every move, but about positioning oneself where probabilities are most favorable and risks are well controlled. In a world of noise and complexity, simplicity often prevails. This method offers a straightforward yet powerful way to engage with markets intelligently, consistently, and professionally. Fourth strategy, riding the bands for trend continuation, understanding the principle of riding the bands in strong trends. Markets are not static. They move in cycles of accumulation, breakout, trend consolidation, and reversal. Recognizing these phases and adapting strategies accordingly is critical to professional trading success. Bollinger Bands, while often viewed as a tool for identifying overbought or oversold conditions, can also serve as a powerful guide for trading in the direction of strong trends through method known as riding the bands. This approach is rooted in the principle that during periods of robust directional movement, price of 10 clings to the outer Bollinger Bands rather than reverting immediately to the mean. The upper band becomes a dynamic boundary in uptrends, while the lower band serves a similar function in downtrends. Rather than signaling exhaustion, these touches often reflect strength, persistence, and conviction from institutional participants. Understanding this distinction is crucial. Amateur traders frequently misinterpret persistent cant, act with the outer bands as an invitation to vet the move, believing price has gone too far. Professional traders recognize this behavior as confirmation of trend health and position themselves accordingly. Identifying valid trend conditions for riding the bands. Riding the bands is not suitable for all market environments. This strategy thrives in clearly established trends characterized by consistent higher highs and higher lows in uptrends, or lower highs and lower lows in downtrends. Confirming this structure through higher timeframe analysis enhances confidence in these TUP. Visual cues include Bollinger Bands widening progressively, reflecting expanding volatility in the direction of the trend. The slope of the bands, particularly the middle moving averages, supports the trend direction. Additionally, momentum indicators such as their relative strength index often remain in overbought or oversold territory for extended periods, reinforcing the strength of the prevailing move. Volume analysis also provides valuable confirmation. Healthy trends typically exhibit increasing volume on impulsive moves and decreasing volume on corrective pullbacks. This behavior aligns with the concept of riding the bands as price surges along the outage driven by committed market participants. Executing the riding the bands strategy with discipline. Execution within this strategy requires precision and an understanding of market behavior rather than blind adherence to rules. The objective is to enter in direction of the prevailing trend during brief consolidations or minor pullbacks that respect the integrity of the trend structure. Uptrend, look for price to consolidate near the upper band without significant retracement toward the middle band. Consolidation patterns such as flag spennants or tight ranges near the upper boundary of 10 preceded continuation moves. Entries taken on breakout confirmation from these patterns with stops placed below the consolidation low or beneath the middle band. In a downtrend, the inverse applies. Price consolidates near the lower band with breakdowns, providing short entry opportunities. Stops are placed above the consolidation high or middle band to respect the structural integrity of the downtrend. Profit targets can be managed through a combination of fixed reward to risk ratios, trailing stops beneath higher lows, or using projected volatility measures, such as the average true range to estimate potential price expansion. Psychological considerations and common pitfalls. Perhaps more than any other method, riding the bands challenges trader psychology. The natural human inclination is to perceive price that has moved significantly in one direction as unsustainable. This bias leads stop premature attempts to pick tops or bottoms rather than recognizing the power of momentum. Successful execution demands the discipline to follow the trend until clear signs of exhaustion emerge. These signs include failure to make new high soar lows, divergence in momentum indicators, weakening volume on rejection candles forming at key levels. Until such evidence presents itself, staying with the trend remains the higher probability approach. Another psychological hurdle is managing trades through inevitable noise in demon or pullbacks within the broader trend. Traders must differentiate between normal consolidation and genuine reversal signs. Overreacting to minor corrections often results in missed opportunities or unnecessary exits. Risk management in trend continuation trades. Effective risk management is paramount when riding the bands. Despite the high probability nature of continuation trades within strong trends, no method guarantees success. Position sizing must reflect this reality, ensuring that any single trade carries a manageable impact. Overall portfolio health, stop losses should be placed beyond logical structural points, not arbitrary percentages. This approach respects the integrity of the trend while providing clear invalidation levels. Tightening stops prematurely based on fear rather than market structure undermines the edge of the strategy. Scaling out of positions as the trade progresses allows for profit protection while maintaining exposure to potential extended moves. This technique reduces psychological pressure and enhances flexibility in trade management. Case study illustration of riding the bands. Consider a major index exhibiting a pronounced uptrend on the daily chart. Bollinger Bands widen progressively with price consistently hugging the upper band. Pullbacks remains hollow, finding support in a middle band, but failing to breach it. Momentum indicators showed steady in overbought territory without significant divergences, signaling sustained buying interest. During one consolidation phase, near the upper band, a tight flag pattern forms, accompanied by declining volume. The breakout from this pattern occurs an increased volume with a strong bullish candle closing above the consolidation high. A trader enters long with a stop beneath the consolidation low in the middle band. The position is managed through it railing stop beneath successive higher lows, capturing the continued advance until signs of exhaustion appear. This disciplined approach yields significant reward relative to risk, demonstrating the power of aligning with trend momentum rather than attempting to predict reversals prematurely. Integrating riding the bands into a broader trading framework, riding the bands complements a diversified trading approach, serving as a method for capitalizing on strong trends across timeframes and asset classes. It pairs effectively with breakout strategies, mean reversion tactics, and volatility plays, allowing traders to adapt to varying market conditions. Incorporating higher time frame analysis enhances this strategy. Identifying monthly or weekly trend structures provides context for daily or intraday execution. Aligning trades with macro trends increases the probability, tie-off success, and reduces exposure to false signals. Combining this method with volume profile analysis, sentiment data, and fundamental factors further refines trade select timing. A comprehensive approach recognizes that no single tool offers in isolation. Professional traders synthesize information to build robust trade theses supported by confluence. Avoiding common mistakes in riding the bands. Common errors stem from misapplying this strategy in unsuitable conditions. Attempting to ride the bands during range-bound markets adds to frustration as price repeatedly reverses within confined boundaries. Recognizing the absence of clear trend structure through higher timeframe confirmation prevents such missteps. Overtrading is another frequent pitfall. Traders may chase entries after price has already extended significantly from consolidation, leading to poor reward to risk profiles. Patience in waiting for valid consolidation and breakout setups preserves capital and enhances outcomes. Ignoring warning signs of trend exhaustion undermines this strategy. Indicators, such as momentum divergence, diminishing volume on advances, or failure to break previous high slow signal caution. Persisting with positions beyond these warnings often results in giving back profits unnecessarily. Final thoughts on riding the bands. Riding the Bollinger Bands in trending markets embodies the principle of aligning with strength rather than fighting it. This strategy requires a mindset rooted in acceptance of market behavior rather than projection of personal bias. Success comes from recognizing that trends persist longer, and most expectant that price clinging to the outer bands reflects conviction, not weakness. Mastery of this method demands not only technical skill, but also psychological resilience and disciplined execution. Those who develop the patience to wait for proper setups, the discipline to follow their plan, and the humility to accept when trends falter position themselves for consistent success. When integrated thoughtfully into a comprehensive trading plan, riding the bands provides a powerful tool for capturing sustained directional moves. It transforms the Bollinger Bands from mere indicators of volatility into active guides for navigating the complex rhythms of financial markets. Ultimately, trading is not about being right. It is about aligning with probability, controlling risk, and managing emotions. Riding the bands embodies these principles, offering clarity in the chaos and structure in the uncertainty of modern markets. Conclusion: mastering Bollinger Bands for professional trading success, synthesizing the four core strategies into a unified approach. Throughout this detailed exploration of Bollinger Bands, we have examined four distinct yet complementary strategies, each serving a specific purpose within a professional trading framework. These methods are no tessellated tactics to be used randomly, but interconnected approaches that together form a comprehensive understanding of how to read price action, volatility, and market behavior through the lens of Bollinger Bands. The first strategy, focused on trading at the upper or lower bands within range-bound market, emphasizes the importance of recognizing mean reversion opportunities when markets are lacking clear direction. This approach teaches traders patience, timing, and the discipline to fade extremes only when supported by additional evidence. These con strategy highlighted the power of the Bollinger Bands squeeze, a tool for anticipating volatility breakouts. Understanding this concept equips traders to prepare for significant price movements not through prediction, but through structured readiness, recognizing the inherent cycles of contraction and expansion within all markets. The third strategy explored the synergy between Bollinger Bands and exponential moving averages for trend-following precision. This method reinforces the necessity of aligning with prevailing momentum, using objective tools to confirm direction and timing entries with discipline rather than emotion. The fourth strategy examined riding the bands within strong trends, embracing the principle at price, adherence to the outer bands reflects strength, not exhaustion. This technique challenges common misconceptions and equips traders to capture sustained moves through clear structure and robust risk management. Together, these strategies provide a holistic framework adaptable to varying market conditions, time frames, and asset classes. They demonstrate that Bollinger Bands, when properly understood and applied, are far more than a simple volatility indicator. They are a dynamic tool capable of guiding professional decision-making across the full spectrum of trading scenarios. The mindset behind consistent execution. While technical knowledge forms the foundation of any trading strategy success, ultimately hinges on the mindset with which these methods are executed. Bollinger Bands, like any tool, require a trader to approach markets with patience, discipline, and emotional resilience. The ability to wait for clear setups, to act decisively without hesitation, and to manage trades with detachment from outcome distinguishes professionals from amateurs. Consistency in application is markets offer endless opportunities, but only those aligned with the strategies outlined should be pursued. Deviating from these principles often results in inconsistency, frustration, and losses. Maintaining focus on process over outcome ensures that statistical edges are realized over time. Risk management remains paramount. No single trader, regardless of how promising, should jeopardize the integrity of the trading account. Proper position sizing, stop placement, and profit-taking strategies protect against inevitable drawdowns and allow for low and term sustainability. Psychological fortitude is especially critical when managing trades through periods of volatility, uncertainty, or drawdown. Recognizing that most robust strategies will experience periods of underperformance prevents emotional reactions that undermine the broader plan. Building a professional trading framework. For those committed to mastering their craft, Bollinger Bands should be integrated into a broader trading framework that includes elements of fundamental analysis, macroeconomic awareness, and time and study and market structure comprehension. This comprehensive approach ensures that trades are not based solely on indicators, but on a holistic understanding of the forces driving price action. Continuous education remains a cornerstone of professional development. Markets evolve, and so too must the strategies and the traders who employ them. Reviewing performance journaling trades and seeking mentorship or collaboration within communities of like-minded individuals fosters growth and refinement. Backtesting and forward testing the CEST. Rate Gs across various instruments and conditions, builds confidence in their efficacy, and helps identify optimal parameters for individual trading styles. While the principles remain consistent, nuances may vary based on asset class, time frame, and volatility profile. Avoiding common misinterpretations of Bollinger Bands. One of the most frequent mistakes among newer traders is misapplying Bollinger Bands as predictive tools rather than reflective measures. They do not forecast direction, but illustrate current volatility dynamics. Understanding this distinction prevents misuse and enhances effectiveness. Another pitfall is the temptation to overtrade based on every interaction with the bands. Professional traders recognize that not all touches or squeezes present viable opportunities. Context confirmation and confluence remain essential filters for decision-making. Ignoring higher time frame trends while focusing solely on short-term band behavior often leads to counterproductive trades. Aligning entries with the broader market direction increases probability and reduces exposure to false signals. Finally, abandoning strategies after short-term underperformance reflects a misunderstanding of probability-based trading. No method offers certainty. Consistency over large sample sizes delivers results, not isolated outcomes. Why Bollinger Bands remain relevant across market cycles. The enduring popularity of Bollinger Bands among institutional and retail traders alike speaks to their versatility and effectiveness. They adapt dynamically to changing market conditions, providing clarity whether markets are trending, consolidating, or transitioning between phases. Their visual simplicity belies the depth of information they convey. When used correctly, they reveal the heartbeat of the market, highlighting areas of compression, expansion, overextension, and equilibrium. Their integration with other tools such as moving averages, volume analysis, and momentum indicators enhances their utility and precision. Bollinger Bands serve not only as entry and exit guides, but as a framework for understanding the underlying psychology driving price movement. Recognize when markets are stretched, fearful, euphoric, or complacent through the bands empowers traders' top position accordingly with confidence. Final words for the serious trader. Mastering Bollinger Bands requires more than technical knowledge. It demands a professional mindset rooted in disciplined patience and a commitment to continuous improvement. It calls for respect for market behavior, humility in the face of uncertainty, and a steadfast focus on process over outcome. Those who dedicate themselves to this mastery will find that Bollinger Band offer far more than trading signals. They provide a window into their rhythm of markets, a structure for decision-making, and a foundation upon which consistent profitability can be built. Remember, trading is not about prediction, it's about preparation, risk management, and alignment with probability. Bollinger Bands, when used correctly, align the trader with these timeless principles. If you have found value in this comprehensive guide and seek to deepen your understanding of trading psychology, strategy, and professional mindset, I invite you to become part of For Growing community. At Trading Mindset Lab, we believe that success in trading is not reserved for the lucky or the gifted, but for those willing to cultivate the right mindset, build disciplined processes, and continually refine their craft. Our mission is to provide traders with the insights, tools, and community necessary to elevate their performance beyond mere tactics to true professional thinking. Whether you are a seasoned professional or an aspiring trader seeking clarity, you will find actionable. Leave a lunar content by subscribing to Trading Mindset Lab. You gain access to in-depth analysis, practical strategies, psychological frameworks, and exclusive resources designed to help you thrive in the competitive world of trading. If this content resonates with you, do not hesitate to subscribe now. Join a community committed to growth excellence and their relentless pursuit of mastery in trading. Subscribe to Trading Mindset Lab today and take one step closer to trading with the mindset of a professional.